Hi, everyone. Welcome to Retire with Style. I'm Alex, and I'm here with Wade.
Hey everyone, and Alex and I are joined today by Nate Conrad from Lifex Funds at Stone Ridge, and we're excited to talk about retirement income bond ladders in relation to the tool that Lifex now has developed with a suite of ETFs. So Nate, welcome to the show.
Thank you for having me. Excited to be here today.
Yeah, and so for our audience, now we know some audience members may be familiar with Lifex. It has gone through some changes over the years. It's now a suite of ETF funds, no longer age-based like it was in the past, focused on the idea of retirement income bond ladders. And so that's really going to be the topic of the conversation today. But we do want to make clear everyone listening understands if you're familiar with Lifex from a couple years back, you'll want to take another look at it today. It's designed even I think up to 40 years of protected income, and that's one question I'd like to dive into deeper about how that works. But yeah, that's going to be the conversation today: retirement income bond ladders. And if you could just tell us a little bit about how you got to the point of developing a suite of retirement income focused products to help Americans as they get to retirement, and what's special about especially the inflation protection and so forth.
Sure. Happy to. So, I come from a background in bond trading, and, we'll see if I can make Wade blush a little bit here. Uh, when I started learning about the retirement income space, it was from reading Wade's paper about the efficient frontier for retirement income and learning about the way that income annuities can really reshape the way you think about a portfolio and create better outcomes for people in retirement. And for me and quite a few of my colleagues, including everyone up to our CEO, Ross Stevens, we really fell in love with this idea of how can we drive better outcomes for people by improving the way fixed income plays a role in the portfolio. And, in your work, you did a lot talking about the way income annuities fit in. And from our perspective, the challenge is just that most Americans haven't adopted that product as a solution. So there's this incredible efficiency that you've documented academically in a better way to build portfolios. And we set out on this mission, that we're now about 7 years into, of figuring out how can we help more people get the benefits of this kind of an approach where you think about solving for spending needs and separately solving for growth, and build those two things together, and call it a bucketed approach that will ultimately drive better outcomes, both in terms of satisfying spending needs over the course of your life, as well as helping you achieve, maybe a greater growth outcome or a greater legacy outcome in expectation, of course, with some degree of risk when you're using investment products that have inherent risk. So that was really what set us off on the path.
Okay. And yeah, I mean, getting into things, I think a lot of listeners are familiar with bond funds, and this is technically a bond fund as well, but it's a bond ladder version of a bond fund, whereas most bond funds are like a constant duration bond portfolio. So could you talk a little bit about that, and when you're focused on funding a retirement liability, why you may want to think more about duration matching your liability with a retirement income ladder rather than using a constant duration bond fund?
Sure. And maybe we'll get a chance here today to unpack it both, from a quantitative, numerical perspective, as well as, maybe from more of a human perspective. You when you just think about, quite bluntly, the name fixed income, we
Mhm.
call it that for a reason, which is that people began accessing fixed income by buying bonds where you know the coupon, and you know the amount of the principal, and you know when everything's supposed to be paid. And when you buy the bond, unless that issuer defaults, everything is totally fixed. And you know the income, and you know the cash flows. And when the mutual fund came along and when the ETF came along, those provided a dramatically simpler way to access fixed income in a diversified manner, compared to you yourself going out and buying hundreds or thousands of individual bond CUSIPs if you wanted a big diversified, you know, Bloomberg Ag style portfolio. But when we packaged fixed income up the way we did as an industry, we really lost that virtue of totally fixed income. because when you buy a bond mutual fund or a bond ETF, the income varies year to year based on whatever the yield of the fund happened to be that year. And you never get your principal back until the day you sell, and you don't know what it's going to be worth if you're going to sell at a market price. And so for us, the observation was that as we packaged up this academic concept of diversification, which is so powerful, in reducing risk, not eliminating it, but, really, really reducing it, we lost the true property of creating fixed income. Whereas a true bond ladder, where you own a series of bond maturities, your coupon income, your principal income, and you can design something that actually really aligns with your spending function. When you do that, the only risk you have is issuer default risk if you're just holding those things to maturity and spending them. Whereas we've created a new risk for people, which is market volatility based on the duration or the credit spread of what they own. And having to sell at that volatile market price ends up, from my perspective, having a pretty stunningly negative impact on the safety of that spending plan that people create for themselves. And that's what you really see come out when you study these things in a Monte Carlo or in financial planning systems.
Yeah, I mean, I guess the way I think about that too, like with a bond fund in a total return investing environment, it's really just meant to reduce volatility, not because you're using it as fixed income, but because it has a lower standard deviation than maybe some of the other asset classes you're looking at. But that's more for an accumulation framework. We got to emphasize we're talking about a liability here. You're trying to fund a retirement spending goal. And what does it mean to just have a less volatile, but still nonetheless still volatile asset class, because it's not linked to your spending need compared to a bond ladder that has, as you said, coupon payments as well as maturing face values that you've anticipated will fund the expenses as you go each. Now, actually, with these funds, each month in retirement, there's a distribution, not as it is usually with treasuries where you're going to get 2 payments a year. Could you talk a little bit more about that as well? Just how the actual design of Lifex works to provide that income?
And just to chime in here, when you do that, can you do that within a comparison, at least a little tidbit of a comparison? Because I'm thinking of folks listening in, thinking about, wait, is that a bullet sort of share kind of thing? That kind of, just to touch upon that as well.
Sure. So, I think when most people think about a bond ladder, one of the typical approaches people create in a bond ladder for simplicity is they're really going out and buying something like one bond maturing every year for a horizon, maybe 3 years, 5 years. And so just for example, let's say you're building a 5-year bond ladder. You've got $100,000 and you buy $20,000 of a bond maturing in 2025, 20,000 in 2026, and so on, equal weight over 5 years. That's, I think, probably the most common shape of a bond ladder in the market today. And if you think about the experience you have owning that product, you have cash flows that are quite lumpy and spread out because your principal is going to come back to you in annual chunks, every time one of those bonds matures. And you're also getting this coupon income that actually decreases over time, assuming you're spending the money that comes out, because in the first year you have 5 bonds paying you coupons, and then the second year you have 4, and so on. So if you create a bond ladder that way, which I think is the most common format, it's very hard to live your life using that to plan spending, because you got to spend money all year long and you have this uneven and lumpy thing. And if your income is decreasing because of the way those coupons bleed off, most people's spending doesn't decrease over time. If anything, it increases with inflation. And so what we wanted to create in our product is both, the call it like one ticker, easy way to access a bond ladder by wrapping it into an ETF, but also really adapt to the human way we live our lives, which is we're spending money every day and we got to pay our bills every month. And so what we created is a suite of ETFs that pay a distribution every single month. And behind the scenes, you have to do something a lot fancier in the way you shape the bond portfolio to be able to create smooth monthly income. But we do all that work behind the scenes in the ETF, so that as an ETF investor, you just get to collect that monthly distribution. And we offer a couple different flavors of those payouts. So we have one set of ETFs that targets what we call a level pay framework. So for instance, our LDDR ticker is designed to go through the end of 2035 and to give you the exact same distribution per share every single month through 2035. And so if you wanted to try and target spending $1,000 or $10,000 a month every month through 2035, it's very easy to figure out how to target that using LDDR. We have a second version that's really meant for longer horizons that we describe as front-loaded. So if you wanted to create a 30-year or a 40-year plan, what we do is we target a distribution of $10 per share in the early years and $7.50 per share in the later years. And the thought process there is that for a lot of people, their spending needs are higher when they're in their 60s or in their 70s and they're in a little bit better health, more travel and expenses of that nature, and then it tends to decline over time. And so that's about a 25% tilt towards the early years. And then we have another framework that is targeting a CPI-linked payout style, where we're investing in TIPS instead of regular government bonds. And each year, the goal is to adjust that distribution based on inflation, which on average over time you expect to be positive. And really, we think of that not as you're making money by getting a higher level of distributions, but rather, if you didn't get that, your real spending power would be decreasing. And so we're trying to provide you a real spending power over time.
Yeah, and so those are, like, to just reiterate, 10 years, 15 years, and 20 years for the level or inflation adjusted. And then I think it's 23 years through 40 years for the either level pay or inflation adjusted, but then with the 25% reduction for the final 20 years. That might
exactly
be
right.
An interesting point. So, like, whenever we've talked about TIPS ladders or treasury ladders, 30 years has been the max. Could you talk a little bit about how you're able to go beyond the yield curve in that manner?
Sure. It's a bit of a quantitative answer. So if you'll forgive me for being a little bit nerdy about it, the trick of the way we operate our funds that go beyond, let's say, 2055, which would be about as long as you could go if you're just buying the longest dated U.S. government bond. When we start to look at 2060 or 2065, the key insight that underlies how we manage that is that there's really not much that we could learn in the world tomorrow that will impact interest rates in, let's say, 35 years in a way that's different than the way it'll impact the interest rate 25 years from today. And so when you look at that from a statistics perspective, what you would say is that the 25-year forward interest rate is extremely correlated, very nearly correlation 1 to the 35-year forward interest rate. And so the way we decompose the problem when we think about hedging that 35-year forward interest rate is that we proxy hedge it with something more in the 20 to 30-year range, where there are a lot of bonds to choose from. And we buy a quantity that is adjusted to reflect the duration risk and the convexity risk that is inherent to those longer term bonds. And then over time, over the next decade, as the government comes to market with more bonds, we actively manage that portfolio through time to continue to replicate that risk as best as we can. And so it's not, hedged to the 100.0 percentage point, but we think it's a pretty effective way to mitigate that risk and to create reliability all the way out to 40 years. Take all that work off of the, end investor, so that you can be 55, 60 years old and start thinking about planning, out through the end of your financial planning horizon. And by wrapping it into an ETF, it not only takes away some of the work, but ETFs have these great features of the ability to do tax efficient, in-kind, create, redeem, and other ways of minimizing both kind of the tax and the transaction costs associated with that rebalancing through time. So it's not quite as simple as a set it and forget it bond ladder, but because we wrap in an ETF, you get a little bit more of that set it and forget it experience.
Yeah, and if somebody wanted to do beyond, they get the 10-year version. Was there a lower? What are the lengths again on this?
So we have as short as 2035 and as long as 2065.
Okay,
there are
so
about 40 different ETFs, so a lot of room.
Someone could pick up the 2035, and then at 2035, there's no more, and so they would just get another one at that point if they wanted to continue a ladder, right?
Yeah, so a lot of different ways people think about using them. I think probably the most common way that we've seen in the market today is a lot of people, really believe in this idea of long-term investing. And, if you can stay in the stock market for at least a decade,
sure,
you feel very confident that you're going to have a positive return. So the question is, how do you set yourself up as effectively as possible to stay invested for the long term? And covering your spending needs for that first decade with a bond ladder is a way of, really letting you leave that investment portfolio hopefully untouched for a decade plus to really pursue compounding. Hopefully worry a little bit less about the ebbs and flows of the market.
No, but this is like a viable bridge. If you bring in a financial planning component, folks like to delay Social Security.
Mm-hmm.
Correct. And so a lot of bridging, we get tons of questions with regards to bridging strategies. And this is almost a bond ladder in your pocket bridging strategy here, if you will.
Mm-hmm. I think there are a lot of people out there who like to use the quote that when you're in retirement, income is the outcome.
Right. Uh-huh.
And the human thing is just all about like where's the money coming from to spend every month. And it's all well and good to say that deferring Social Security is a good idea, but I still got to go pay my bills. So what should I do?
No, I understand.
And so just what's the purpose of bonds in the portfolio? Let's give them the purpose that matters most to people, which is how am I going to spend money and how am I going to think about generating that in a conservative approach? I don't want to generate my spending money personally by relying on the price of the S&P. Whereas, if I can buy a bond that's going to mature and it's the U.S. government, I feel pretty good about that.
Well, this touches upon the other saying you hear a lot where personal finance is more personal than finance. And so, walk us through the behavioral stuff. Why do you think that's an added benefit to this whole thing?
So when you think about the experience of owning, I think Wade used the phrase more like constant duration bond fund. I think it's a good way to describe it. I think once you really look into the experience, you start to wonder why is that the default way people own bonds? Because to me, it doesn't actually have very good experiential
outcome. A vestige of accumulation based in thinking.
Exactly.
Which is fine if you're doing that, where the bond fund could be a ballast for the portfolio. You're not looking for income. You want the dampening of the volatility, if you will, but it's different in retirement. Hence,
exactly. So, you buy, let's say, an intermediate 5 to 10 year horizon target duration bond fund. Interest rates go up 2%. And that's what happened roughly in 2022. And at that type of a bond fund duration, you're probably talking about a markdown, in price space of 5 to 10%.
Yeah.
And for people who came into 2022 owning that sort of a fund, they came into the year with a yield on those funds of about 1.5%. And if you own something yielding 1.5%, and then you take a 10% markdown, that is more than 6 years of that yield lost on paper.
I think bond funds were down on average like 20%.
Exactly. So
something like 20 plus.
You're sitting there saying, I've wiped out a long, long time worth of earnings. I'm sitting here underwater. And how am I going to claw back out of the hole? And it's a constant duration bond fund. So it's not as if you can say, well, I'll just, wait till it matures and get my money back.
Yeah.
You're in it. Whereas if you owned a bond ladder that was, let's say, a 5-year horizon, it's going to decrease on paper in market value. But as long as that issuer doesn't default, you're going to get the exact income and the exact principal that you thought when you were getting out. And so if you came into that with a held to maturity mindset, maybe you don't even care at all that interest rates went up 2%. So you have this terrible experience on the one hand versus maybe not caring at all on the other hand. That's if rates go up. Rates go down, you just flip the whole thing on its head. If you own, the bond fund, now you have a price gain. Let's say it happened because, the stock market crashed and interest rates fell. What you might want to be doing is saying, I'm going to take some of my bond money and rebalance it into the stock market to balance out my portfolio. But now what that's saying is, you have this low returning asset, it appreciated, and now it's time to pay a bunch of capital gains by selling that thing and writing a check to the government and creating leakage in your rebalancing. Or, if you're trying to spend money, the same thing, you got to sell it to get the principal out. Versus if you own the bond ladder, you're probably saying to yourself, gee, I'm really glad I locked in interest rates when they were higher. Now I'm going to be collecting that same interest and principal that I wanted, even though rates have gone down.
What would happen if someone had to sell, let's say, the 2035 fund, and 2030 comes in and they have to liquidate? Are they subjected to the same slings and arrows of a normal bond fund?
Roughly the same. Price could be higher or lower. You'll have a capital gain or loss based on changes in bond prices. The one thing that's different, though, is it's not a constant duration bond fund.
That's what I wanted to get at in their answer. But
in 2035 versus today, the bonds it owns are going to be shorter dated. And so as it goes through time, because those bonds are shorter and shorter dated, the price volatility gets smaller and it kind of pulls to par, if you will.
I got you.
And so there should be relatively smaller capital gain or losses to be realized the closer you get to the end year. And when you think about the cash flow you're getting out of this thing, today the monthly distributions of that 2035 fund are a little over 11% distribution rate per year. And as you go through time, we're returning capital to you. And so the NAV is going to go down. And so when you fast forward 5 years and we've returned capital for 5 years, that distribution rate is probably going to be a lot higher. And so you might actually not even have to sell it all because the cash flow is just coming back to you so quickly as a percentage of the asset value.
Yeah, especially if you're not using it as for income, you're just going to reinvest to some extent. But I think this is the key here. There's a behavioral piece where, okay, there's some price stability, if you will, because you're taking everything, you're just waiting for things to mature. But I think also, sure, people can construct this, but talk about like the PETA factor here. Just that alone, just having everything in one wrapper just makes a lot of sense from just an ease of execution.
What was the factor there, Alex?
This is a rated G podcast.
So, when I've spoken to financial advisors who believe in the power of laddering, there are those out there who believe so strongly in this that they go out and they build a bond ladder for, a few or a lot or every single client. And they go out and buy every single CUSIP. And one advisor told me that every single time he adds a new client, he spends about 3 hours building a spreadsheet and going out and buying all the different bonds and getting that in place. And that's a lot of work.
You mean an advisor wants to actually work? Doesn't want to work? Really?
And then just imagine that you want to make a change. How many people do you know that have a bond ladder that add to it or redeem from it because they want to rebalance their portfolio?
100%.
If you think about a 10-year horizon, if you want to get cash every month for 10 years, 10 years times 12 months, that's 120 CUSIPs. So imagine just for starters placing 120 trades, and then imagining saying, I think I just want to make like a 5% change to the weight of my portfolio. I'll just go place 120 trades to reduce it pro rata or to add pro rata. I've never met anybody who put up their hand and said they do that. I think
it's not practical. And I'm even thinking the reporting. If you do quarterly reporting, a performance report it would almost look like hieroglyphics at a certain point.
And in January, I did a workshop at the Retirement Research Academy about how to construct a bond ladder. And yes, it gets incredibly technical when there are coupon payments. Mm-hmm. There are shortcuts. Like there's this nice website, tipsladder.com, that will tell you what to buy. But then you have to actually go out into the secondary market and buy a ton of individual bonds. So even with shortcuts, someone builds a spreadsheet for you to show you what you need.
I mean,
It's
sometimes with strips,
complicated.
but
Yeah.
yeah,
And
great.
in tips, there's like a 5-year period where there just are no maturities. And
Yeah.
so,
Yeah, right.
there's realities to it, both the practical of do you want to do that amount of work? Then there's, what's the quality of the product you get? And it is the same thing that you would get here. There's a book that I love called Atomic Habits. And the whole purpose of the book is,
Yeah.
how do you create and adopt and, entrench habits?
I just want
And
every
one of the keys
podcast
is
to be
make it easy.
1% better.
Yeah. How do you make things easy so that people actually do it? And when you look at, how do we get to a place where people actually diversify and use a buy the market philosophy? We got there not because people said, well, let me just go buy 500 individual stocks. We got there because we have the index fund and a mutual fund or an ETF, and everybody does it that way, even if you could save a few basis points buying 500 stocks yourself.
So you're saying Lifex is kind of like to bond laddering as an index fund is to stock investing?
That would be a wonderful thing for people to think that one day.
But but to be clear, you're talking about from a logistics standpoint. Yeah, absolutely. It makes life a lot easier. And when you do that, there's just less errors involved.
Uh-huh. Another thing I think that's worth looking at, you shared with us a case study that you ran, getting at this idea of, we're back to concentration bond funds again, but if you looked at running through basic financial planning software, investing over 20 years to fund spending for 20 years using an intermediate term government bond fund. That we've had recent episodes about Monte Carlo, so the listeners are up on this. A 4.2% average rate of return with a 5% standard deviation. That was the assumptions driving the simulation, and how much you could spend with that versus if you know you're holding those bonds to maturity and you know what the liability that you're funding is. You've already talked about the potential for paper losses, but when you hold those bonds to maturity, you're not a professional bond trader. You're someone who's trying to have predictable income for your retirement. There's really not any standard deviation. And when you looked at that, what did you see in terms of those outcomes about potential spending from a pot of assets?
So, this is one of those where, you have a directional intuition and you have no idea what the magnitude is. And I thought there was going to be something here, and I was pretty surprised by how big the effect was. So, like you said, the test we ran was, imagine for simplicity that you had a portfolio that is purely 100%, core government bonds. You get your spending every month by collecting whatever the yield is and then selling to get principal. And the study, using third-party financial planning software said that you could safely spend about 5% of your starting principal every month for 20 years. And that path in the Monte Carlo had about an 85% probability of success, 15% probability of failure. And that was, 4.2% return of bonds was the assumption. That's pretty close to where interest rates are today in the government bond market, and a 5% volatility. Plug that in, you can spend about 5% of your portfolio every month. And the intuition we had was that you're taking a lot of risk there. There's a 5% volatility, you're selling every month. That should be injecting risk and hurting your ability to spend safely in this plan. And so we wanted to know, if you just built a bond ladder instead to create income every month for 20 years, what would that let you spend? And we used the same 4.2% rate and just did, time value of money discounting of 20 years of spending. And we got a spending rate more like 7.5% instead of 5%. And so, for somebody who's, got $1 million in their nest egg, that's the difference between spending, $50K versus $75K. It's a pretty incredible difference. And it's not a statement that you're earning a higher return. Really, you should be earning in expectation the same return. You own, something returning 4.2% in expectation either way. It's a story about risk reduction through holding to maturity and constraining the risks of your bond investing to be, really a function of issuer default risk, and stripping out the volatility of selling at a market price. And so to us, that's the whole story of, whenever in finance you find something that you believe gives you the same return with lower risk, you have to ask yourself, why am I not doing that?
I think there's one more piece there. This is intuitively that I don't think you can work it into the study, but Wade talks about this as well, Wade, and I'm going at it where if you've earmarked your retirement income from this particular source, it gives you a lot more flexibility to do different things with the other portion of the investments. That you don't have to kind of leave a just in case amount in that other part.
Right. And that's important. Like if somebody is just kind of trying to follow through in their mind, how could you spend 50% more from the bond ladder than from a bond fund that has the same average rate of return? Well, the idea is the bond ladder would deplete to zero after the 20 years. In 85% of the simulations with the bond fund, there's still money left. I saw the report you shared, like on average, about 20% of your initial balance is left after the 20 years. So it's not that you're assured you'd hit zero, but this is the whole question around, in this case, there's not longevity risk because we're talking about 20 years. But if I'm going to self-manage market volatility, I'm forced to spend less to help ensure I don't run out of money. And so it's almost like, well, if I could spend 50% more from a bond ladder, I can earmark less assets to the bond ladder. That frees up other assets on the portfolio to be a source of true liquidity. That you talk a little bit about that as well, how you might have money left with that approach where you're spending less, but you're forced to allocate more assets to that spending goal when those assets could have been freed up to do other things instead.
Yeah, no, exactly. I think there's this idea that for some people is an initial reaction of how do I create safe spending power. And the idea is I'm going to own bonds and I'm not going to touch the principal. I'm just going to collect the coupons. I'm going to spend only the coupons and I'm going to create safety by not touching that principal. And what we're talking about here is really the opposite idea. The idea is, no, let's spend the principal.
Yeah, and Jane Austen world of living off the interest.
I think there are two huge unlocks in spending principal, even though it's not always intuitive until you really think about it. And the first is tax. Obviously consult your own tax advisor. I don't give tax advice here, but imagine you're doing this in a brokerage account. The coupon is the thing you pay tax on, maybe federal, maybe state, maybe local, assuming we're not talking about munis. The principal is what you can spend tax free. And so meeting your spending power with coupons is very expensive from a tax perspective, whereas getting your principal back is very efficient. So there's one unlock there. And the other unlock is that when you think about what's in your portfolio, bonds are typically going to be the lowest expected return asset. And so the amount of bonds that you need to own, if you're going to spend the coupons, or if you're going to barely dip into the principal, you need to own a lot of bonds to do it that way. Whereas if you say, I'm going to spend down this slug of bonds over the next 10 years, 20 years, 30 years, whatever it is, if you plan to spend that all the way to zero, that lets you own less bonds. And if you own less of a lower expected return asset and more of a higher expected return asset, then an expectation, what do you have? A higher expected return portfolio, and you're going to be able to pursue compounding a bit more aggressively based on that sort of a change to the book.
I mean, the only caveat there is just make sure the overall allocation doesn't creep up well beyond your risk tolerance.
Exactly. You got to figure out for yourself or work with your advisor.
Like the non-laddered part of it, sure, it doesn't need to be earmarked for distributions, which, to use your phrase, is a huge unlock, but it still can't be like an albatross of an emotional roller coaster where that part keeps you up at night. Because as you are drawing down the ladder, you're technically less in fixed income.
Correct. And as you said, personal finance is personal.
Yeah,
There's no one right answer. You got to figure out the one that's right for you. But I think it's worth, just to 100%. Think about the opposite argument. What does a target date fund do? A target date fund says you're getting older. Yeah. We're going to dial down your equity risk. We're going to give you lower expected return portfolio. And we're going to take your long duration bonds and move them into short duration bonds. Probably different funds work differently. I think that's roughly the way the industry works. And to me, that is we're giving you a lower expected return fund, and we're solving for a stable NAV because you're going to get your money by selling every month. Whereas if you release this idea that you get your money by selling at the market value, you get it instead by decumulating bonds through maturities, I think you come to the opposite conclusion. You say, I want long enough duration bonds to lock in interest rates for the duration of my financial plan. To me, that's safer than owning really short duration bonds. And a 95-year-old who has a very short remaining life expectancy shouldn't need very many bonds to fund expected spending needs. And a lot of those assets are actually probably meant to be legacy assets going to the next generation, in which case, why would the answer be that you should have 60, 70, 80% bonds when you might be able to fully cover, a 2 standard deviation, surprise and life expectancy with a pretty small allocation to bonds. So to me, some of the conventional glide paths are completely the opposite of what you should really do once you come to believe that laddering and maturing bonds is a better way to get money out. I think you actually start to consider flipping glide paths and going the opposite way.
Well, sounds like a rising equity glide path.
I feel like I heard that somewhere before.
But yeah, I think the math backs that concept at the very least. And back to the behavioral side, the bond laddering concept can make it much more palatable to actually implement something like that as well. Alex, I think you were planning out some questions. Do you have anything else?
Well, I just wanted to, you mentioned it at the beginning, and I think we've gotten this a lot in where people were like, what is this again? And we had to, we came back and asked you, but I don't think we touched upon it. You had alluded to the payments as they come in. There's one that's steady and there's one that's more variable, and you're trying to align it with financial planning studies that are out there. I think that's an interesting piece, because I know that we got a question that referenced the Lifex ETFs, and they said something like, well, they front load the income and then later on it's much less, something along those lines. You want to talk about how you think about income spending in that framework?
Sure. Some of my thinking here is informed by David Blanchett's work. I think he called it a spending smile, and came up with that metric that it's about a 25% decrease in real spending terms. And so when you look at what we do, and we call them our longevity ETFs, where we do this front loading concept, it is that 25% change, either in nominal distribution targets of $10 a share becomes $7.50, or it's in real terms where it's $10 becomes $7.50, but with an inflation adjustment that's designed based on CPI. And so, the way I look at that, if I'm trying to figure out how I create spending power for myself effectively, when we return, distributions of $10 versus $7.50, the way we do that incremental distribution of $10 is not that we're generating a higher return. It's just that we're doing more return of capital. We're giving you your own money back faster in those early years and a little bit slower in the later years. And so by accelerating that return of capital and giving that back to you at a faster rate early on, that's free from tax. So you're getting that money back tax efficiently. If you don't want it back, you can always reinvest it, or go put it to work in your portfolio. So I think it doesn't hurt you in that respect. And you actually pay me less management fees because I'm billing an asset-based fee and I'm giving you back assets earlier. So I can tell you it's not from a selfish perspective that we hand back the assets earlier.
I just wanted you to kind of, in no uncertain terms, say, yeah, that's a feature, not a bug.
Yeah, exactly. Absolutely. And if people want the flat payout path, we have that too in our term ETFs. But for me, if I wanted to plan out 30 or 40 years, I would rather want it front loaded. And it's really, the mindset we always bring to product design is we build the product that we would want for ourselves. That's how we create alignment. This is the product I want my parents to own. And so that's the way we think about it. And we absolutely see that as a feature, not a bug. We want to help you get that tax-free spending power. It's an option. And if you don't want it, you reinvest it, you put the money back to work. But if we didn't distribute it, then you wouldn't have that option to spend it safely you'd be back to having to sell if you wanted to get the extra money out earlier
Yeah,
on.
so they have the ability to work it as they want. Wade, I'd like to ask you one more question, but I'll open it up to Wade simply because who would have known? 40 minutes talking about bond ladders.
Yeah, well, I
Wade, do
mean,
you have anything before I ask a final one to Nate?
yeah, I think that point about the reduction in spending later, you're absolutely explaining that right, and it's just an actuarial type calculation. The first time one of our listeners pointed that out to me, he thought it was more of a gotcha that spending's cut. But just to be clear, like if someone went to tipsladder.com, I did check like before we recorded, a 30-year tips ladder had a 4.54% payout rate, whereas the inflation adjusted Lifex ETF over 30 years is higher at 4.96. But just to make sure it doesn't confuse people, those aren't completely comparable calculations because the final 20 years would have a reduction in spending. So just so that make sure everybody understands that. But no,
Absolutely, yeah. Don't let anybody be fooled. We're not returning more than any other tips ladder or bond ladder. It's all we're doing is trying to create the return of government bonds, but
you're just trying to align it to somebody's
way.
life cycle a little bit more.
Yep.
All right. And Nate, how can someone find out more about the offering?
So we have a website, lifexfunds.com. And, particularly given we have so many different ETFs and different ways to create a spending plan, highly encourage you to go on there, go to the Our Funds page, and that's where you can see what all the options are. And there are some tools there that enable you to think about if you're targeting a certain amount of monthly or annual spending power, if you have a certain amount of money you want to put to work, and help you think about what that can represent in these different types of spending paths and try and tailor something that feels right to you. So feel free to check it out on the site. And if you want to get in touch with us, there's some information on there to help you reach out either by email or by phone to get help figuring it out.
Excellent.
Yeah, in the show notes, we can add a link to the Lifex Funds website for listeners to get more information as well. While we're talking about things we'll put in the show notes, I do need to also mention I'll be at the Dallas Money Show on April 6th. The event is April 4th through 6th. It's in Grapevine, Texas, right by the Grapevine Mills Mall, where I like to go to their round one with my youngest son to do the crane machines. We become real big on winning prizes from crane machines. So I was excited that's right next door there. But we'll put a link to that if anyone in the Dallas area wanted to go to the Dallas Money Show.
Wait, you got time for that, and you don't have time for pickleball?
Crane machines is very precise.
Come on, man. Work on your hand dexterity with a paddle. All right. Hey, you forgot the question. We got one more question.
No, I didn't forget.
Oh, sorry. Sorry.
We got our listener question. And I picked it. Actually, it was the newest comment on the YouTube page, but it aligned perfectly with the discussion. So I thought, wow, there's some synergies here. But and Nate, I'll ask you to answer the question as well. GC Burkett says, now here to the question that he's asking. So if your funded ratio, and we've had a bunch of recent episodes about that. So just your ratio of assets to liabilities. If your funded ratio is over 100%, should you invest more conservatively? So this means effectively, if you have enough assets to meet all your liabilities to fund your retirement successfully, so that you now have surplus wealth beyond that, should you invest more conservatively?
Should I go first, Wade?
Sure, absolutely.
Your response is recorded.
I guess I'm probably supposed to start by disclaiming that I don't provide financial advice. And I'll just tell you what I would do in that situation. When I like to think about kind of bucketing and goals-based investing frameworks, and the way I think about that is if I'm funded above 1, I'm going to use a bond ladder type solution using my funding equals 1 to completely cover the spending needs that I have. And everything above that is where I get to go to work and take that and try and grow that in something more and invest more aggressively, because even if all that goes to 0, if I've used a really conservative strategy to cover all my funding needs, I'm okay. And so I'm creating a bucket that is my spending bucket. I'm covering that with a government bond ladder. I'm not getting creative. I'm not doing corporates or something like that. A boring and basic government bond ladder for my funding needs. And then everything else, I want to go actually be quite aggressive in the way I deploy the rest and try and turn that into something where I can really make an impact in giving that away to the causes or to the people that I care about. But, again, putting my own personal life view on it, I'm not going to wait to give that away to do so through my will. I'm going to be pretty thoughtful about when and how am I going to give that away. And for me, when my daughter's old enough to have a kid, I'm giving her a night nurse, I'm helping with tuition, that kind of thing.
Yeah, there you go.
Yeah, I think that's a great answer. It's probably the GC was thinking like the old, if you've already won the game, should you stop playing? But yeah, just to follow through with that idea, you should be the most conservative when you're underfunded because you don't have the ability to take that risk. And I thought this question matched perfectly today with that conversation we had about the Monte Carlo, where if you can earmark a portion of your assets to get that 100% funded status fully covered, anything above that is gravy, exactly like you were saying, Nate. And so it's more you invest conservatively when you're underfunded. Once you get overfunded, you don't invest everything aggressively. You exactly like you're saying, you can lock in your goals, stop playing the game to make sure your lifestyle is covered. But it's that surplus wealth over 100% funded that you now have some wiggle room with, and you have the risk capacity to, you don't have to invest it more aggressively, but you're certainly justified doing so if you'd like to.
Yeah. Wait, am I going to see any of that surplus wealth in your will to me?
Coming your way.
No.
If you're nice.
No, that was great. And folks may be wondering, we think highly of Nate and the gang at Lifex, and we thought, you know what, this is a story that should be told. And there it is. Thank you for being on the show, Nate. Really appreciate it.
Thank you, Wade. Thank you, Alex.
Yeah, thank
Alrighty.
you. And thanks everyone for listening. We'll catch you next time on Retire with Style.